Most people ask, how much return can I make from this stock? But the real question is, how does the stock generate returns? Unless you know that, you're just shooting in the dark. So today, let's find out how a stock generates its returns. When you invest in a stock, it pays back in two ways. One is dividend, which is when the company pays its profits to its shareholders, and the other is capital gain. It's the profit you make when you sell the stock at a price higher than what you bought it for.
Some stocks balance both steady dividends and strong growth. Some prioritize reinvesting profits to fuel long-term expansion and innovation. Others focus on delivering consistent dividends, providing reliable income over time.
ITC, for example, paid consistent dividends for years without any price movement. But now that the stock has doubled, investors are also enjoying capital appreciation. It's worth talking about the dividend yield here. Dividend yield is calculated by dividing the annual dividend per share by the stock price per share. This shows how much dividend a company pays relative to its stock price. A high dividend yield could mean a company is distributing a substantial amount of its profits to its shareholders. A lower dividend yield, on the other hand, could mean that the company is reinvesting the profits back into the business. Always check the company's financials, growth strategy, and price movements before making any decision. Now, let's talk about taxes. Dividends are added to your income and taxed at your slab rate. For example, if you're earning 1 lakh in dividends and you fall in the 30% tax bracket, you would be paying 30,000 rupee tax. Capital gains, however, are different. If you hold a stock for more than 12 months, you pay 12.5% tax on gains above 1.25 lakh. Below that, it's tax-free. Short-term capital gains are taxed at 20% flat. So, growth stocks can be more tax efficient, especially for high earners. But most investors ignore something. Dividends can be paid multiple times a year. If reinvested, they can compound your returns. Capital gain, on the other hand, occurs only when you sell the stock. So while dividends may be less tax efficient, they offer steady income that you can reinvest. See, it's not about picking one over the other. It's about understanding which one works best for you. Smart investors use both dividends for stable income and growth stocks for wealth creation. Do you have any questions on dividends versus capital gains? Drop them in the comments and we'll answer them right here.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.